Welcome back to the Deep Dive. It is Sunday, February 1st, 2026. We're officially 1 month into the new year, and honestly, the corporate news cycle hasn't taken a breath yet.
It really hasn't. Earnings season is in full swing, and the numbers are telling some very specific stories about where the economy is heading.
And speaking of stories, today we're focusing on a company that, let's be honest, most people didn't think twice about until 2020. Then suddenly, they were in everyone's bathroom cabinet.
Mm-hmm.
We were talking about Abbott Laboratories. But if you're still thinking of them as the COVID test people, you were looking at a snapshot from 3 years ago.
Which in the medical technology world, I mean, that might as well be 3 decades ago.
Exactly. We are looking at a giant that is currently executing a massive high-stakes pivot. We're digging into their Q4 2025 earnings, which just dropped, their 2026 strategy, and specifically this eye-watering $23 billion check they just wrote.
Yeah, that $23 billion figure it's really the center of gravity for this entire discussion. It signals a fundamental shift in how Abbott sees the future of medicine.
It's a huge number, and the mission for this deep dive is to figure out if that number makes sense. Are they buying a revolution in cancer care, or are they maybe overpaying for a business model that might be peaking?
That's the key question.
We're going to unpack the financials, the technology, specifically the sci-fi stuff like biowearables and heart lasers, and the significant risks lurking in their nutrition business.
Because it is not all smooth sailing. I mean, you have a company that is 136 years old trying to pivot like a Silicon Valley startup.
Right.
That kind of turn creates friction.
Friction is a polite way of putting it. We have lawsuits, price wars in China, and a consumer base that is just, frankly, tired of inflation. But let's start with the basics to set the scene. It's February 2026. What does the Abbott empire actually look like today? Because it's not just one thing.
No, and that is the most critical thing to understand about their business model. Abbott is designed to be a diversified healthcare leader. Think of it as a four-legged stool.
Okay.
In 2025, they generated $44.3 billion in sales. But that money, it comes from 4 very distinct pillars that often move in opposite directions.
Okay, let's walk through the 4 pillars. What's leg number 1?
First, and currently the heavyweight champion of the portfolio, is medical devices. This segment brought in $21.4 billion last year.
Wow.
That is roughly 48% of their total sales.
So nearly half the company is now just high-tech hardware.
Correct. And it is the fastest growing segment by a long shot. This is where the innovation premium lives, the heart valves, the glucose monitors, the pacemakers.
Okay, so that's the star of the show. What's the second pillar?
The second pillar is diagnostics.
Yeah.
This brought in $8.9 billion, or about 20% of the total.
And this is where the COVID story lives and dies.
Dramatically so. I mean, if you look at the trend line, COVID testing sales dropped from $747 million in 2024 to just $297 million in 2025.
Whoa.
That revenue stream has essentially evaporated compared to the pandemic peak.
Which makes sense. I can't remember the last time I bought a rapid test.
Exactly. The market has moved on. The core diagnostics business, the big machines in hospital basements running blood panels, that's stabilizing, but the easy money is gone.
Got it. Okay, pillar number 3.
Then we have the third pillar, nutrition. $8.5 billion in revenue, about 19% of the total.
And this is the baby formula and Ensure shakes.
Yes. And as we will definitely discuss later, this is currently the problem child of the family.
The problem child, okay.
Okay.
I'm making a note of that. And the fourth pillar.
The fourth is established pharmaceuticals, or EPD. $5.5 billion, about 12% of the pie.
Now, I always find this one interesting because of the branding. Established pharmaceuticals.
Yeah.
Abbott spun off their cutting-edge drug business years ago.
Right, into AbbVie.
Into AbbVie. So what is left in EPV? It sounds like old news.
What's left is branded generics. And here is the key distinction. This revenue is 100% international. They do not sell these products in the United States.
Okay, so why does someone in, say, India or Brazil buy an Abbott generic instead of just the cheapest option available?
It's one word, trust. In many emerging markets, supply chains can be dodgy. counterfeit drugs are a real serious problem.
Right.
So a middle-class family in Mumbai or Sao Paulo is willing to pay a premium for an antibiotic or a painkiller that has the Abbott stamp on it because they know it's real.
Ah, so it's a brand equity play.
Precisely. It's a volume play on the rise of the global middle class.
Yeah.
And it's a cash cow. It helps fund the high-risk R&D in the medical devices segment.
So you have these four legs: devices, diagnostics, nutrition, and pharma. Why do they insist on keeping them all together? I mean, Wall Street usually loves to break companies up to unlock value.
Sure.
Why not spin off nutrition or pharma and just be a pure play med tech stock?
Management calls it portfolio protection, and the last 5 years are the perfect proof of concept for that strategy.
How so?
Think about 2020. Hospitals shut down. Elective surgeries, they just stopped. The medical devices business tanked because nobody was getting new knees or pacemakers.
I remember that, yeah.
But the diagnostics business exploded.
Because the world needed testing.
The world needed testing, and now fast forward to today, February 2026. Diagnostics is crashing back to earth, but medical devices is surging because everyone is back in the hospital catching up on those procedures.
So when one cylinder misfires, the others keep the engine running.
Exactly. It smooths out the volatility. And that stability, that's what gives them the confidence and the balance sheet to make massive bets like the Exact Sciences deal.
I see.
They can afford to be wrong in the short term because the portfolio protects them.
Okay, so that's the foundation. But reading through the JP Morgan transcript and the strategy updates, it feels like they are tired of just being stable. They want to be transformative. There is a very clear pivot happening here from, treating the sick to optimizing the healthy.
That is the strategic inflection point. That's the perfect term for it. They are moving aggressively into mass market consumer tech. They are blurring the line between a medical device you get from a doctor and a gadget you buy at Best Buy.
Let's talk about Lingo, because I've seen the ads for this, and it feels like they are trying to come for the Apple Watch crowd.
They absolutely are. Lingo is their new bio-wearable. It's based on the exact same sensor tech as their world-famous diabetes monitors, but it's for people without diabetes.
So explain the pitch.
Yeah.
Why does a healthy person need to track their glucose 24/7?
The pitch is metabolic mastery. The target market is, first, the 98 million U.S. adults with prediabetes, and get this, 80% of them don't even know they have it.
80%.
80%. Plus the biohackers, the athletes, the general wellness-obsessed crowd. It's the quantified self movement. You stick this little sensor in your arm, it talks to an app on your phone, and it tells you in real time how your body reacts to that bagel, or that poor night's sleep, or that stress spike during a big meeting at work.
I was reading about the AI integration. They're calling it Libre Assist. It sounded wild. You take a photo of your meal, and the AI predicts your glucose spike before you even take a bite.
That is the behavioral nudge. I mean, think about it. It's one thing to eat a donut and see your blood sugar spike an hour later. It's a whole other thing to have your phone warn you, hey, if you eat this, you're going to crash in 2 hours.
It gamifies your metabolism.
It completely gamifies it.
Right.
And the data they released bears that out. Abbott reports that 95% of users change their habits after using Lingo.
99%.
They switch foods, they change eating times, they add a walk after lunch. It's moving healthcare out of the clinic and into the wellness aisle at the pharmacy.
And from a business standpoint, that's just a massive expansion of the total addressable market. I mean, patients are a limited group.
Right.
Consumers are everyone.
And unlike a pill that you take and forget, a bio-wearable is a subscription. It's a consumable sensor. It creates a sticky, recurring revenue stream with incredibly high engagement.
But they aren't just making consumer gadgets. They're also doing some really heavy lifting in the operating room. I want to dig into Volt. This is their new pulsed field ablation system.
TFA, yes. This is, without a doubt, the hottest topic in cardiology right now.
So help us understand the stakes here. This is for treating atrial fibrillation, or AFib, right?
Yes. AFib is an irregular heartbeat. It affects about 12 million Americans, mostly over 65. And what happens is the heart basically quivers instead of beating effectively, which can lead to strokes and heart failure.
And how have we treated it historically? What's the old way of doing it?
For the last 20 years, the standard of care was basically thermal warfare.
Thermal warfare.
Doctors would thread a catheter into the heart and either burn the tissue with radiofrequency energy or freeze it with cryoballoons. The goal was to create a scar that blocks the bad electrical signals causing the arrhythmia.
Burn or freeze, that sounds medieval. and risky.
It is effective, but it's a blunt instrument. I mean, the heart sits right next to the esophagus and the phrenic nerve, which controls your diaphragm.
Oh,
If the doctor's hand slips or if the heat just transfers a little too far, you can paralyze the diaphragm or, in rare cases, burn a hole in the esophagus.
that's catastrophic.
It is. It's rare, but when it happens, it is catastrophic.
And this is where Volt and PFA come in. How is it different?
PFA changes the physics of the problem entirely. It doesn't use temperature at all. It uses ultra-rapid, high-voltage electrical fields. The technical term is irreversible electroporation.
Okay, break that down for me. Electroporation.
Think of it like a sniper rifle versus a flamethrower.
Okay.
The electrical pulses are tuned to a specific frequency that affects cardiomyocytes, heart muscle cells, but essentially ignores the nerve cells and esophageal tissue right next to them. It's tissue selective.
So the electricity punches holes in the bad heart cells to stop the arrhythmia, but the critical nerves nearby are untouched.
Exactly. The pulses create these microscopic pores in the cell membrane, causing the targeted cells to die off. But the structural integrity of the surrounding tissue, the collagen matrix, it all remains intact. It removes the collateral damage from the equation.
That explains why I read that the Volt study enrollment finished 4 months early. Doctors must be lining up for this.
They are desperate for this safety profile. It allows them to work faster, more confidently, and treat more complex cases.
And strategically for Abbott, this creates a massive moat.
A huge moat. Making a generic pill is relatively easy chemistry. Building a mapping system that delivers microsecond electrical pulses while sensing catheter contact force inside a beating human heart.
Yeah.
That is a technological fortress.
It's hard to copy.
It's extremely high barrier engineering.
Right.
And this is exactly why Abbott is betting so hard on medtech. It's defensible.
So we have the futuristic tech, but we have to talk about the engine that's paying for all of this innovation, the Freestyle Libre.
The cash cow.
The ultimate cash cow. I knew it was popular, but looking at these Q4 numbers, $7.5 billion in revenue from one product line.
It is, by many metrics, the most successful medical device in history.
That is a staggering number.
And it's still growing like a weed. That $7.5 billion in 2025, that's up from roughly $6.4 billion the year before. That is 3 consecutive years of growing by more than $1 billion.
Wow.
There are over 7 million people globally wearing these sensors right now as we speak.
But I want to challenge the growth narrative for a second, because a year or two ago, Wall Street was in a panic about the Ozempic fear.
Oh, yeah.
The theory was that GLP-1 weight loss drugs would cure obesity and diabetes, and nobody would need these glucose monitors anymore.
That was the prevailing bear case. Investors thought Ozempic and Mounjaro were going to absolutely kill the CGM market.
But looking at this latest report, that clearly hasn't happened. It seems like the opposite happened.
No, not at all. In fact, Abbott released data showing that 40% of Libre users in the U.S. also use GLP-1 drugs.
So they're synergistic. They work together.
They are completely complementary. I mean, think about human psychology. If you are taking an expensive injection every week to manage your metabolism, you want validation. You want to see it working.
Seeing is believing.
Exactly. The CGM gives you that immediate visual feedback loop. You see the drug working. Abbott calls it the companion diagnostic effect. The device reinforces the lifestyle changes the drug is supposed to be supporting.
So far from killing the device market, the drugs have actually raised awareness about metabolic health.
Which drives more people to the devices. It's been a net positive.
And they are expanding the market so aggressively. It's not just for people on intensive insulin anymore.
That is the big shift. Historically, CGMs were for type 1 diabetics. Abbott is pushing hard into the type 2 market, specifically people who aren't on insulin or maybe only take it once a day.
Right.
And now with the new Libreo getting FDA clearance for over-the-counter use, they are covering the entire spectrum.
From the biohacker trying to optimize their sleep with lingo,
all the way to the type 1 diabetic who needs it to stay alive.
it is a land grab for metabolic data.
Yeah.
And right now, Abbott is winning.
No question.
Okay, let's pivot. We have to pivot to the elephant in the room, the $23 billion elephant.
The acquisition of Exact Sciences.
This is the headline of the year, maybe the last few years for them.
It is.
Let's just stop at that number for a second. $23 billion. So looking at the deal sheet this morning, and the premium here is eye-watering. They're paying $105 a share for Exact Sciences. That is not a bargain bin price. That is a We need this house, and we don't care what the asking prices kind of offer.
It is fully priced, no doubt about it, but you have to look at what that $23 billion is actually buying. They aren't just buying the current revenue of Cologuard.
The poop in a box test.
The poop in a box test, yes. They are buying a monopoly on the transition of cancer care from the hospital to the living room.
Okay, so explain the assets. What do they actually get for that money?
They get Cologuard, obviously, the undisputed market leader for non-invasive colorectal screening. They get Oncotype DX, which is a crucial genomic test for breast cancer that helps doctors decide if chemotherapy is actually necessary for a patient.
Which is huge.
Huge. And they get a pipeline of new tests, including CancerGuard.
CancerGuard is the multi-cancer blood test, the so-called Holy Grail.
Correct. The idea is a single blood draw to screen for multiple types of cancer, many of which have no good screening method today.
But is it a monopoly? Because I see competitors popping up all over the place with blood tests. Liquid biopsy is a huge field. Isn't there a risk that Abbott is buying the best technology of today, the stool sample, right before the technology of tomorrow, the blood test, makes it obsolete?
That is the bear case, exactly. You're worried about the Kodak moment, buying the best film company right as digital cameras appear?
Right.
But here is the nuance that the earnings call really brought out. Abbott isn't just buying the box. They are buying the infrastructure.
Logistics.
The logistics. The machine. Exact Sciences has built this incredible machine that can mail kits to millions of homes, get them back, process them, and bill insurance companies. That last mile into the patient's bathroom, that is the real moat.
So even if the test inside the box changes from a stool sample to a blood draw.
Abbott now owns the pipes that deliver it. They can swap out the chemistry, but the distribution network, the physician relationships, the insurance contracts, that is the hard part to build from scratch.
Okay, that makes more sense. But let's look at the financial mechanics, because Abbott was very, very honest in their guidance. This deal's going to hurt for a while.
It is. They explicitly stated the deal is dilutive to EPS in 2026 and 2027.
Dilutive. Okay, that's fancy Wall Street talk for our profits per share going down.
That's exactly what it means. They expect a 20-cent hit to earnings per share in 2026 and a 16-cent hit in 2027.
So it won't be accretive. It won't actually add to their profit per share.
Until 2028 at the earliest.
That requires a lot of patience from shareholders.
Bro.
Why take that hit for 2+ years?
Because they are trading short-term profit for long-term growth velocity. Look, Exact Sciences is growing revenue in the high teens, close to 20%.
Right.
Abbott as a whole grows in the high single digits. By swallowing Exacts, they speed up the entire Abbott ship. They are buying a faster growth rate.
And they are loading up on debt to do it.
They are. Their leverage ratio, their debt to EBITDA is jumping to 2.7 times. That's still comfortably investment grade, but it is higher than conservative Abbott usually runs.
So they're taking on more risk.
They're leveraging up to buy their future. It feels like a very 2026 move. The easy money from COVID is gone. The legacy diagnostics business is shrinking. So you have to go out and buy your next growth engine.
And the engine they chose is oncology.
It is. Management looked at the map and realized that oncology is a $60 billion market. They didn't have a seat at that table. Now, for $23 billion, they bought the head of the table.
Let's bring it back to the immediate picture then. The Q4 2025 earnings. I called it a paradox in our outline because the numbers are kind of all over the place.
It was definitely a mixed bag quarter. That's the perfect description.
They beat on the bottom line. Earnings were good, up 12%, but they missed on the top line. Revenue was light.
Right. Revenue came in at $11.46 billion. And that missed Wall Street estimates by $340 million. That is not a rounding error. That is a significant miss.
And when you dig into why they missed, it points directly to that problem child we mentioned earlier.
Nutrition.
Nutrition.
The nutrition segment's revenue was down 8.9%. For a consumer staple business like baby formula, that is a crash.
So what is happening? Is it just that people aren't buying protein bars anymore?
It's a classic case of pricing power hitting a wall. Over the last 3 years, Abbott, like every other food and beverage company, raised prices aggressively to combat inflation. They passed the costs right along to the consumer, but now, in late 25 and early 26, the consumer has blinked.
They reached the breaking point.
Exactly. People are becoming much more price sensitive. They are trading down to store brands or just buying less. The volume is dropping significantly. Abbott pushed the price lever a little too hard, and now they're losing market share because of it.
And despite that revenue miss, they still managed to beat profit estimates. How?
Operational discipline. They expanded their operating margins to almost 26%. They are squeezing more profit out of every dollar of sales they do make, even with inflation.
Okay, but we need to go deeper on nutrition because the revenue drop is honestly the least of their worries here.
It is.
There is a legal storm brewing that feels very different from a standard patent dispute. We are talking about the NEC litigation.
This is the black swan risk for the stock. NEC, or necrotizing enterocolitis, is a devastating intestinal condition that affects premature babies.
What is it exactly?
It's a condition where the tissue in a preemie's intestine becomes inflamed and can actually die. It has a very high mortality rate. It's just awful.
And the allegation in these 1,000+ lawsuits is that Abbott's cow's milk-based preterm formula increases the risk of this happening compared to using human milk.
Correct. And let's be clear, this is just terrifying for any parent to even think about. The human cost is immense.
And strictly from a financial perspective, you have to imagine that juries are not looking at the corporate entity Abbott in these cases. They are looking at grieving parents.
Exactly.
You saw what happened in that trial in St. Louis against a competitor, a nearly $500 million verdict.
Right. And the scary part for investors is the scientific ambiguity. Abbott argues, and many neonatologists agree, that their formula is life-saving for preemies who can't get breast milk, and that the science doesn't support the specific causation claim being made.
But in a courtroom.
In a courtroom, emotion often outweighs clinical data. It reminds me of the talc lawsuits with Johnson & Johnson. Even if the science is debated for years, the reputational damage and the potential settlement costs can drag on for a decade.
It creates what you'd call a legal overhang.
A huge one.
Right.
Investors hate uncertainty. They don't know if the final bill for this will be $500 million or $5 billion or more. Until that is resolved, the stock price will always have a discount baked into it.
So that's the domestic headache. But looking at their international business, there's trouble in China, too.
China's a tough market right now. We talked about the VBP policy.
VBP, value-based procurement.
Value-based procurement, which is basically the Chinese government setting price controls, right?
Effectively, yes. The government bulk buys medical supplies for the entire country and forces companies into these massive bidding wars to offer the lowest possible price.
And the impact is real.
How real?
In 2025, this policy caused a $400 million headwind for Abbott's diagnostics segment alone.
$400 million.
Yeah.
Just evaporated because the government said lower your prices.
Gone. And that pressure isn't going away. China is the world's second largest economy, and for many Western medical companies, it is rapidly becoming a low-margin market. You can get volume, but not profit.
So they have to run twice as fast to make the same amount of money there.
That's a good way to put it.
So let's summarize the landscape here. You have a company that is absolutely booming in medtech with sci-fi heart lasers and biowearables.
Right.
You have a massive, unshakable cash cow in the Libra sensors.
Yeah.
But you also have a nutrition division that is shrinking and getting sued, and a diagnostics division that is dealing with major price controls in China.
It is a complex picture, no doubt.
And on top of all that, they are trying to digest a $23 billion acquisition that will hurt profits for the next 2 years. So what is the verdict? Is this a house of cards or is it a fortress?
If you just look at the valuation, Abbott is trading at about 19 times its forward earnings.
Is that high or low for them?
Historically, it is low. Their 10-year average is around 24 times earnings. So the stock is on sale relative to its own history.
It's the nutrition discount.
It's the nutrition discount and the exact sciences uncertainty discount combined. The market is punishing them for those two things. But if you believe in the long-term strategy that medical devices and oncology will drive the future, then this is a classic JRAP opportunity.
Right.
Growth at a reasonable price. You are getting a double-digit growth engine in devices attached to a steady cash generator in pharma, all for a lower-than-average multiple.
And you get the dividend.
And you get the dividend. They are a dividend king. They have raised their dividend for over 50 consecutive years. That shows immense financial discipline through all kinds of economic cycles.
So the analyst sentiment is basically the risks are defined, but the portfolio is protected.
That's the consensus, yeah. The medical device growth is so strong, we're talking high double digits in diabetes care and electrophysiology, that it provides a massive cushion while they sort out the nutrition problems and integrate exact sciences.
It feels like they are successfully rotating. They used to be a pandemic defensive stock. You bought them because the world was ending and everyone needed tests.
Right.
Now they are a med tech aggressive growth stock.
That is the pivot. And 2026 is the year they have to prove that pivot works.
It really is impressive when you step back. 136 years old. I mean, most companies that age are dinosaurs.
They are.
Abbott is out here acting like a Silicon Valley startup with these biosensors and these massive acquisitions.
They're refusing to act their age. And you have to say, they used that COVID cash windfall very strategically to buy their way into the future.
And that brings me to my final thought for you, the listeners. We talked about Lingo and Libre. We talked about Cologuard. Abbott is effectively blurring the line between patient and consumer.
It's a democratization of diagnostics, taking it out of the lab and putting it in your hands.
Right. And it makes me wonder, in 10 years, will we all be wearing Abbott biosensors? Will we all be treating high blood sugar before it ever becomes diabetes? Is Abbott becoming the Apple Watch of our bloodstream?
If they execute on this strategy, the answer is yes. They want to be the operating system for your metabolism.
That is a wild thought to leave you with, an operating system for your metabolism. I want you all to go look at those Libre numbers again. $7.5 billion for one device line. That is the scale we are dealing with here.
It's a staggering amount of data and influence.
As always, thank you for listening to The Deep Dive. We will be watching that Q2 closing of the Exact Sciences deal very, very closely. Until next time.
Stay curious.